Okay, let's talk for a few minutes about the financial projections that you're going to include in the business plan. Well, generally, particularly with startup businesses, you're not going to have a detailed cash flow statement or balance sheet. One, you won't have a ton of equipment or assets to put on the balance sheet or outstanding debts very early in the business venture. So that's of lesser importance. Plus, your cash flow statement is going to be ancillary first to the income statement. For planning purposes, the income statement is king, okay? Because it lays out the startup costs, the assumptions that you have along with that, your revenue projections, your expense projections, and then you can include in there your break-even analysis or your targets for when you would need a round of equity infusion or more debt infusion of capital in order to continue operations, to continue a given growth path. So basically, your income statement in the startup phase, along with startup projections, your assumptions there, will demonstrate almost the entirety of your business plan. Someone who is skilled at developing and then reading the financial projections can gain almost everything they need to understand from the operations right there in the income statement. So you'll start out with general presumptions about cost for different things. What level of startup expenses are you going to have for equipment, leases, product and development, pre-launch salaries, things of that nature that are going to be the expenses you incur just to get off the ground, just to get started. Then you're going to have a section to identify what you believe you need in working capital. Now, working capital is basically going to indicate the amount of money you need before you break even or before you get the next round of funding that can carry on operations. So lots of times startup businesses, particularly small businesses, or lifestyle businesses, try to turn the corner as quickly as possible and try to make a profit. So you're trying to see how much money you need to get there. Well, a startup venture is generally not going to make a profit anytime soon because any available money, they're going to spend it on market to achieve that growth curve that they're attempting towards, because growth is generally instrumental to attaining outside equity investment, because your objective is to reach a sufficient size that you can ultimately recapture your money through either the sale of the business or some other exit event, and that the business at some later point will be profitable. But for now, you incur losses by spending outside investor money or debt in order to achieve that growth. So if that's the assumption, you have to demonstrate how much working capital you're going to need until you get to that next level. So you've got your startup cost, and then you've got your working capital that you're going to need there. Then you take that information, and that's what you use to build the income statement. So on the revenue side, you might have in your assumptions that the price that you're going to charge for your product or the hourly rate you're going to charge for your product, you're going to use that to project your revenue at any given time interval, month by month, for the first 12 months, and then maybe every quarter for the second year. And sometimes people will do a third year projection out there, but normally the end of the second year projection is about all you can validly project out to. It already gets tenuous with the month by month and the quarterly. A third year is extremely difficult to accurately project. So anyway, with that in mind, you're going to take the assumptions in here about price and things like that and estimate what your level of sales will be. So you can estimate from that your revenue each given time period. Below that, you will put your expenses or your costs that you will incur. And that will level out at the bottom as either a profit or a loss. And as I said, it'll generally be losses all the way up until, say, with a lifestyle business, you break even, okay? Or with a startup venture, you get your next infusion of capital. Okay, so with that, and that generally comes from an outside equity investor or some ability to incur additional debt, but normally through some sort of outside equity investor. So you will constantly have to compare your expenses against your revenue, and your revenue should be going up, but your losses could also be going up because, like I say, you're incurring a lot of marketing costs and expenses there. And then, like I say, you'll take that period between startup and when you break even or when you get the next round of equity investment, and that will be your working capital needs plus some. You want to have some pillow or some margin. You may want to add as much as 100%, double that amount to account for the amount of money you'll need in working capital to secure when kicking off the business. So that's the general story told by the financial projections in the income statement. Your assumptions about revenue and expenses, which will be your price, and then your given expenses and startup costs. And then your working capital will come from revenue minus expenses added up until you reach some new infusion event. And again, that will tell the story for your projections for sales, expenses, growth rate, etc. Right there in the income statement.